Hello and welcome to NDTV Profit. You're watching IPO Adda, and my guest today is from Inventurus Knowledge Solutions Limited. It's a Rakesh Jhunjhunwala portfolio company. It's involved in tech enabling platform for assisted physicians and healthcare enterprises in the US, Canada and Australia. And joining me today is Sachin Gupta, who is the whole-time director and CEO of the company, and Nitya Balasubramanian, who is the CFO of the company. The company's IPO is opening on December 12th, closes on December 16th, price between 1265 to 1329 per share. It's an OFS of 2,497.9 crores, and that gives the company a value of roughly 22,800 crores at the upper end of the price band. Sachin, thank you for joining us on NDTV Profit. My first question to you is to give us an idea of your business model, and just so that the investors understand how your business revenues come from, or where it comes from.
Great, thank you for the question and thank you for having us on the show tonight. Our business model is all about helping US healthcare deliver better, safer, more efficient care. As you know, US healthcare is the largest industry in the world at nearly $4.8 trillion. And growing at nearly 7%, which is faster than GDP. They already spend more than 20% of GDP on healthcare. So there's a fundamental cost problem and opportunity in US healthcare. But compounding that further is a problem related to access to care, where new patient wait times are as high as 45 to 60 days for primary care and really 6 to 9 months for specialty care. And all that is compounded further where quality of care is actually deteriorating because of the administrative burdens that providers are faced with due to the regulatory changes, predominantly the regulatory changes in US healthcare. So at the confluence of all this, US healthcare needs to undergo a significant transformation. And the transformation that we saw coming was a transformation of a care delivery paradigm of reactive hospital-centric medicine to proactive physician-led and patient-centric medicine, where the most important point of care becomes the physician clinic versus the hospital. Why the physician clinic? Because from the physician clinic, the physicians can engage proactively with patients, and especially for patients that have chronic lifestyle diseases, perhaps change their lifestyles to prevent their disease states from worsening and to eventually bend the cost curve that escalates due to utilization of more expensive points of care like hospitals. So as we saw that transformation happening from reactive hospital-centric to proactive physician-led and patient-centric, we decided to focus on that physician segment of the market, which is about a $1.5 trillion industry in the US. So of that 4.8 trillion, about 30% is the physician segment. And we built a business model over the last 18 years that is specifically focused on delegating chore tasks that distract physicians and their care teams from taking care of patients, such that we take away all those chore tasks and enable them to focus on the core of taking care of their patients. Statistics prior to IKS were that physicians, caregivers were spending as much as 50% of their time on non-patient care, non-discretionary tasks. Post-IKS, we give them back 2 to 3 hours of their time, such that even if they took half of that to lifestyle and half of that back to the practice, now they start to dent that cost quality access storm by providing more number of patients care with the same fixed cost, thereby getting more proactive with patients and hence reducing the cost of care and improving the quality of care. Equally importantly, we are able to transform the financials of these large physician practices, which typically were barely 10% EBITDA businesses. By implementing our platform, we can create up to doubling of their earnings by creating another 1,000 basis points of net margin for their business at the confluence of improving their revenue by about 500 bips and reducing their cost by about 500 bips. So a transformative model, and we basically delegate all these tasks through a platform that we've built called our Care Enablement Platform that leverages the proprietary technology that has been written by our 600 plus technologists over these last 17 years and combines that proprietary technology with our global humans predominantly based in India, and those humans supervise the technology and audit the tasks that are being done by technology to make them safe and secure before those tasks are delivered back into the physician enterprise. So at the confluence of leveraging our technology effectively and our global humans, we are able to produce best-in-class operating margins. Over the last 16 years, we've built a business model that really has produced industry-leading growth over the last 4 years. It's been, north of 25%, and even faster margin growth. Our EBITDA margins going close to 38 to 39%. This is a huge TAM because of that $1.5 trillion. These large physician practices are spending as much as 15% of their revenue on these tasks. That makes it a $225 billion TAM, which means that, if you look at this, the Indian offshore software services industry, that's a $250 billion industry today. We found a TAM that is nearly as large as that entire industry. And of that $225 billion, only 30 billion odd has been outsourced so far. So massive growth opportunity as this TAM unlocks, and this 30 billion goes towards the 100 to 150 billion that it inevitably will over the next 10, 15, 20 years. And our business model gives us the chance to leverage our leadership position of the platform that we've built to capture an unfair share of the unlocking of this TAM.
Give me a sense of the opportunity with respect to India, because you are primarily focused on US, Canada and Australia. The Indian healthcare market is also, organizing itself in a similar model. Do you see an opportunity coming into India? And also give us a competitive landscape. Since you are a platform business, I'm sure there will be other platforms also providing similar services. So give us the idea of how this business is shaping up as the industry expands itself to capture that opportunity.
So I'll start off with your second question first, and then I will come to India, because India is also important in the larger landscape. In terms of the competitive landscape, what happens is when there's such a large TAM across 16 different tasks or features, which we call the chore tasks, that are delegated through the 16 features of our platform, the individual TAMs of many of these tasks itself are very large. For example, we have a task called clinical documentation that we take away from the physician's workflow to alleviate 2 hours of their time that they otherwise spend on clinical documentation. Now, the TAM of just that task is nearly 30 billion. There are other features that have 10, 20, $30 billion TAMs. And as a result of that, many companies got created over the years that were single point solution companies that essentially would delegate one of these tasks or 2 or 3 of these tasks. We saw that as this market consolidated and as the provider behavior matured, they would get frustrated eventually over a period of time with the task of buying 10, 12, 14 different point solutions, integrating them, managing the overhead of 12, 14 vendors, taking accountability of driving outcomes to those vendors. And they would slowly move towards this platform thesis where they realize that the value of the whole platform is much greater than the sum of the individual parts, and they decide to buy more and more of the entire platform. And as a result of that, what we did is we built a company that is not only number 1 or 2 or 3 in each of the features or each of the tasks, but it's probably the only company in the world today that has the full breadth of the platform. So our competitive positioning really is number 1 or 2 or 3 in each of the features, but the only company having the full breadth, which allows us to win today, where there is more dominant point solution buying behavior, but also sets up for winning tomorrow and day after as the buying behavior moves more and more towards the platform. So that's as it relates to the competitive landscape. As it relates to India, obviously Indian healthcare is going to be a huge opportunity in the future. As you know, chronic lifestyle disease as a result of our more sedentary lifestyles is plaguing India as much as it's plaguing anywhere in the world. And so as the Indian healthcare delivery ecosystem matures, as the physician market consolidates, as health insurance becomes more and more pervasive and health insurance starts to reimburse for physician-based care in addition to hospital-based care, I'm sure a similar model would manifest itself in India, and hopefully at that time, which I think is still several years away, we might be able to leverage all of our learnings from the US healthcare ecosystem to bring them to the advantage of India.
Nitya, come in here. Sachin, very well articulated the business model as such. Can you articulate the business revenue model as well? How do you get revenue out of this model?
So we have 2 constructs through which we make revenue. We charge our customers either a percentage of their net patient as revenue, which is approximately about 40% of our revenues. And the remaining 60% is where we have a SaaS-based pricing model where we are charging $1 per physician per month. So that's how we get paid by our customers. And I think if you remember, Sachin had mentioned that we are able to do that because of the value proposition that we bring to the table. we are actually able to increase the revenues of our clients on an average by about 5 percentage points and improve the EBITDA of our customers by almost 10 percentage points. And that's why we are able to therefore charge an outcome-based pricing contract is how we are able to enable it.
Give me also a sense of the kind of change that A-Equity Holding has come and made not only to your revenue but your EBITDA profile, because I was looking at your FY23 numbers, you had nearly 38% EBITDA. It did come down to 28% in FY24 and in the first half at 20.5%. What is the kind of profile that A-Equity brings in, and if you can give us an idea of it?
Sure. See, let me start by reiterating why the acquisition was made in the first place. Two very, very important growth vectors that we get through the acquisition. Number one is our ability now to cross-sell IKS's features into the Acuity customer base. So when we bought Acuity, Acuity had only 2 features compared to the 16 features of the IKS's platform. But what they did have was relationships with 800 customers, 500 of whom are large organizations that we would be prioritizing. So the first growth vector is obviously being able to sell IKS's features into these 500 large customers. The second important reason and a growth vector, a margin expansion vector for us is as we are able to deploy IKS's technology and as we are able to globalize their human capital, we believe that we should be able to fundamentally transform their EBITDA margins as well. So when we bought Acuity's EBITDA margins were around the 12% mark, which is why if you look at IKS's legacy margins, which were at 38-39%, and when you combine this with the 12% of Acuity, the 12-month pro forma consolidated financials, the EBITDA has come down to 24% in FY24. But as we again transform their business model, we will be able to continue improving on the 24%, which is also already evident in the first half financials that we have reported in the RHP. That 24% number has already expanded by 400 bips into 28%. And going forward, we are optimistic that this number will continue to inch towards the early to mid 30s number, which is more closer to the IKS's margin profile.
And so, is there a timeline to that? The glide path, which is to mid 30s, which you're talking about?
So around 18 to 24 months from now, we believe we should be able to get to the steady state of early to 30% EBITDA margins.
Sachin, Nitya spoke about the fact that you're going to target 500 of the 800 customers that Acuity Holdings is going to bring in. What is the kind of opportunity that you see there in terms of the revenue and the of course the margins profile will come in there because you're going to replace existing vendors there. But what is the kind of opportunity that you see in that 500 customers?
Yeah, so it's very exciting, and that is really the cornerstone of the thesis of combining the two companies. So like Nitya was saying, they have 500 large customers and their 500 large customers employ about 120,000 physicians. And of course, legacy IKS had about 45 odd large customers with about 35,000 physicians. So when you look at the combined installed base, you're talking about 545 customers with 155,000 physicians, which is nearly 18% of all of America's 900,000 physicians. So when you just model the cross-sell impact of our 16 features across these 155,000 physicians across legacy IKS and legacy Acuity install base, you're talking about a revenue opportunity of about $28 to $29 billion. Today, together, we are barely about $315 million in revenue. That creates nearly a 80-90x growth opportunity in our captive enterprise scale customer base. And really the next 8, 10, 12 years of our journey is towards activating that cross-sell motion and capturing a lion's share of that base. And so today, what we've done is we've actually sorted and stratified 50 of their 500 Acuity customers, and we are very focused on activating the cross-sell motion with those 50 customers. As we see success with those, we would have created a playbook that we can then replicate and scale across the larger install base of 500 customers. But keep in mind, each of these 50 customers itself has a potential of being up to a $60 million ACV, annual contract value customer. So even if you activate this across 10, 15 of these 50, you're talking about tripling the business. So I think we feel very, very excited about the cross-sell possibilities in the combined install base.
How much of these customers are you able to hold on to it, and are there any customers which are dropping off after this acquisition?
So we feel very, very lucky and vindicated that over the last year, we haven't lost even one of the 500 customers that we wanted to cross-sell to. Of course, there are 300 additional customers beyond these 500 that are very small, onesie, twosie doctor clients. Over a period of time, we might lose those, but the 500 high-value, large customers, we haven't even lost one, and that gives us great confidence in the durability of the relationships that Acuity has built with those customers, and hence our ability to cross-sell the platform thesis into them.
Nitya, can you comment here on the average revenue per client, especially for the top 10? It's come down a bit compared to what it used to be. Any reason why it has fallen?
So IKS Legacy had a very proactive, thought-out strategy of working with fewer large clients and continuing to penetrate them deeper and deeper. So if you look at FY23, IKS had about 49 different legal entities that we were working with, where we had a very deep relationship. When we acquired Acuity, they of course bought many more customers, 853 to be precise. And that's the reason you will find some of them are actually larger clients who will now be amongst the top 10. But that does bring down the average because we now have a lot more number of customers in the install base.
One question on the valuation part as well. You're coming out with an IPO with an upper band of 1329 per share. I was looking at your capital structure, and I think in May 2024 you did a private placement at 824 rupees. The pricing of the IPO is nearly 61% higher than the private placement. Any idea why you have priced it at a premium to that private placement in May?
So I think the price discovery happened through the course of many conversations that we had with public market investors. And I would urge you to again look at the kind of growth profile as well as the margin profile that IKS Legacy has, and the kind of scope that the combined might of IKS and Acuity now has to be able to continue growing in the future. I think it's a combination of these is how the valuation discovery has happened. Sachin, anything you would like to add here?
Yeah, no, I think that's exactly right. And the only thing I'll add is that the price discovery happened in deep consultation with what I think are some of the best banking advisors that we have involved with the issue. It was based on feedback that they received from institutional investors, which of course will become evident in the anchor book that opens this Wednesday. And then of course in deep consultation between our banking advisors and our board, this was the price band that came out. And so we feel like it is a relatively fair description of the opportunity set that IKS represents.
To be fair, there has been secondary market transactions in IKS shares in which investors like Madhukela have acquired at 1325 rupees per share, and including some other large alternate investment funds, and they have also acquired these shares from various existing investors of IKS. Sachin and Nitya, thank you very much for joining us today on IPO Adda. Your IPO is opening on December 12th. Closes on December 14th, price between 1265 to 1329. It's an OFS of nearly 2500 crores, which values the company at 22,800 crores at the upper end of the price band. Thank you for joining us today.